The number one misconception about raising capital from angel investors and venture capital investors is that VCs, venture capital, are just out for the money. We're diving into a quick venture coaching session. This time we're talking about the types of investors that you might run into when fundraising for your business. Angel investors, venture capital firms, corporate venture capital firms, and then finally grants and other programs like that. So of course, there are many other ways that you can raise capital. Those are the big four, and we're gonna dive right into it. While angel investors might be attractive because you're actually getting the money from a person, you can put a face to that opportunity, oftentimes these are not professional investors. These are individuals with their own careers, their own brands, or they're so successful, they're already retired. So a lot of times raising capital from angels can be great, but they are not necessarily contributing as much to the investment team as you might see from a professional investor. Venture capital firms are portfolios of capital that are being collected from an individual or group of individuals known as the general partners and management team. They raise their money from LPs, limited partners, wealthy investors that give money to the fund to then deploy into a diverse set of investments. Venture capital firms have a mandate to deploy. That means they have to spend this money. They're not receiving it as investment from investors to sit on it and wait. They usually will have a 3-4 year timeline to deploy that capital, and then they need to see returns on that in order to generate a total return for the fund. Venture capital firms take a management fee, which is a fee over the total assets that they have that is very small, and then they actually take a larger portion of what they call the carry, which is the return on the investment made. Because of the fact that venture capital firms want to see a return on their investment in a short period of time, that often means that they're going to be more likely to contribute resources as well as connections and relationships to you in order to help you get to that next phase. They may be instrumental in closing new clients or working with their portfolio. You don't always see that from angels. Angel investors are usually individuals. When you're an individual that is providing capital or investing into a startup, this is off your own balance sheet. When we talk about balance sheets, that is how much money you own. Angel investors are people taking their own capital and investing it into deals. For these types of investors, they don't have a mandate to deploy the capital. No one's forcing them to spend their money. They're usually investing because they really care about the cause, they care about the mission, they care about the founder themselves. They're doing it for their personal drive and excitement around the industry. Angels are often in the seed or Series A portions of the capital raised. These are smaller rounds that are more accommodating to an individual investor. However, one benefit of angel investors is that they're often very chill. They are not necessarily going to be breathing down your throat. Moving over to corporate venture capital, this is where you have a large corporation, a big company, traditionally a very mature company that has additional capital that they can contribute to research and development. But instead of actually researching and developing their own products, some of these companies will create venture capital arms of their own. This means that they're likely going to be a much more business relationship. There's going to be less about the innovation and much more about synergies with that overarching company, but it can present huge opportunities for locking in a large corporate client or a potential acquisition in the future. With regards to the debates between angel investors and venture capital, I really think that you want to have a healthy mix of both. Having angel investors is amazing, and it's something that I think is a great way to get a business off the ground. You're going to find individuals that are passionate about the cause, that want to help out, that are not necessarily going to ask too many questions in those early phases of you establishing your business. However, by taking it to the next level, bringing on some professional, well-connected investors that have dozens of portfolio companies, that have worked with many other investors that they can help bring to your team, is a great way to turbocharge your business. And I definitely don't think you should pick one or the other. Working with both can be key and instrumental in building out a successful cap table. Finally, you have all kinds of grant and what we'd call non-dilutive capital. This is types of capital that are traditionally given as awards, as tax benefits from nonprofits and things like that, that are given as a non-dilutive capital source. When we say dilution, we're talking about diluting the equity in the cap table. So non-dilutive capital is capital or investment that's being given to a company with no exchange of equity, which is potentially really beneficial for the startup who doesn't actually have to give much but is able to receive capital in order to grow their business. Traditionally, these are very small awards that are given for sustainability projects or for the betterment of society. So you'll see all kinds of different corporate plans or government plans or nonprofits that are creating grant programs to give to new and upcoming entrepreneurs with small businesses that just need a little bit of operating capital to get off the ground. And that's a quick primer on the different types of investors that you're going to see, some of the ones that you might work with, and some of the ways you can raise capital. As always, click the links in the description to join my venture community, to get on a call with me and talk more about your business. If you have any questions, leave comments below and tune into the next episode where we talk everything VC.